If the stock exchange is like a racetrack, Hong Kong wants more horses to bet on, even if they aren't all thoroughbreds. In an effort to boost IPO volumes, Hong Kong Exchanges and Clearing, the city's stock exchange operator, proposed new guidelines on Wednesday that would significantly reduce the threshold for IT businesses wishing to list. What are the founders of Pets.com up to these days? Stock markets require a continual stream of initial public offerings, IPOs, not only for prestige, but also to generate trading activity and fees. The New York Stock Exchange staved off IPO withdrawals in the early days of the pandemic by slipping in a surge of firms going public via SPAC mergers, an option Hong Kong eventually opened for itself earlier this year. However, Hong Kong's insatiable IPO thirst is not easily quenched. According to geologic data provided by the Wall Street Journal, primary and secondary listings garnered just under $11 billion on the market so far this year, a decrease of more than 70% from the same period in 2021. The scarcity has weighed heavily on the exchange, with revenues down 78% year-on-year. The proposed regulatory changes are intended to entice the type of tech companies, semiconductor manufacturers in particular, caught in the crossfire of the trade conflict between China and the United States. Still, given how many listings failed during the recent lengthy bull market, we're looking at you, Blue Apron and Robinhood. The sole winner of reducing the bar in our present high-rate environment may be indexed. The new rules would divide listing candidates into commercial companies, which must have at least $31 million in annual revenue, roughly half of what the current rules require, and pre-commercial companies, which must have a market capitalization greater than $1.9 billion and a clear path to $31 million in annual revenue, among other requirements. The idea follows a series of dismal Hong Kong debuts last month, when the exchange's two largest IPOs, Chinese EV producer Zhejiang Leapmotor Technology and China bank-backed residential property manager Onewo, both debuted in the negative after raising $800 million and $733 million, respectively.